Hey everybody, I'm Zach.
And I'm Jesse.
And you're watching Disruptive Investing News. And I wanted to focus this week on Arrival. This is the UK-based EV startup.
Now, we visited their UK headquarters back in the fall of 2019.
That's right. Remember, they SPAC'd back in March of 2021. They trade on NASDAQ under the ARVL ticker symbol. We can show you the stock chart here. And, ow, ouch.
Yeah, I didn't know you could get that low. They're working on electric buses and these delivery vans that they plan to make at local mini factories.
Right. We followed them for quite a while. We talk about them a lot over on our Patreon in our investor club. And we've spoken with Arrival president Avinash Rugenboer over on Patreon. And as we can see from the stock chart, things aren't going that well.
Yeah, and now they're reporting that they are laying off half their workforce, or about 800 workers, as a cost-saving measure.
They also announced a new CEO, Igor Torgov, moving up from the EVP of digital position that he's held since 2020. Now he's CEO.
And we've been saying on Investor Club for quite some time that we're not that impressed with Arrival.
Yeah, I mean, if the disruptive idea behind Arrival is that they think they can create their vehicles more efficiently at micro hubs, which you're seeing here in this video, then they've never really convinced me of why that was.
Yeah, the argument has gone something like this. Make the vehicle right where the demand is, and you save on transportation. But I think that they leaned too heavily on the idea that they could print parts on demand. I've just never understood how it saved money.
Yeah, if you're watching this video right now, it looks a lot like many companies do when they get to that part where they have to go from the prototype to making a handful of vehicles. And I'm not saying you can't do that, but to make them cost effective, you have to be able to produce quite a number of them quickly. Here it looks like, I mean, through the magic of editing, it looks kind of quick, but I think if you know what you're looking at, a lot of those steps that seem to be fun with the music playing and the things moving around are actually very slow. And so it's not that they can't do this. I think you can set up a microfactory and make just about anything, but let's just talk about like the supply of the parts. You have to get the parts you need delivered to that location, unless you're going to make all of them yourself. They kind of implied that they would be making a lot of them themselves. And here they showed, like at the beginning of the video, that they were like cutting out parts with a cutter and stuff. And again, it's not that you can't do that. It's just that that's a really expensive way to make a part. If you're going to make a bus, let's say, full of seats, much cheaper to have hundreds or thousands of seats made somewhere that make them cheaply and delivered to you. Or, I mean, you can vertically integrate it and make your own seats, but you have to do it in a mass production style. Right. You can't just be like, today we're going to make 10 seats.
This strategy that they have of the microfactories ignores scale. And that's the part that I've just never understood. The reason why Tesla has been able to do what they do is because they have scaled it, right? And it's almost like Arrival gets to say, oh, scaling is, you don't need to do that.
Yeah, and that, I mean, look, it's easy to kind of sell that to investors before you've lost all your money. It's because people will think like, oh, I guess we never understood it. Look, you can disrupt things, and sometimes disruption does look different than the way it happened before. So I think a lot of investors are like, okay, let's give them a chance. But Arrival stock lost 80% of its value in 2022, and now they are down to about $205 million in cash left, which they said back in November may not give them enough runway to even get through this year of 2023.
And don't forget that this is after they already laid off 30% of their workforce last year.
Yeah, they let go of 800 of their 2,500 workers last year. Now another 800 workers are going?
Yeah, Arrival is trying to get down to a $30 million spend per quarter, and I just don't see how they're going to pull off enough production to get to profitability now.
Right, because again, it's not that you can't keep your company going at that price, but you have to be able to make enough products to make enough revenue, and not just revenue. And I think this is really key. Revenue means that you sell something and you get some money for it, but that's not the whole picture.
Because you had to spend
money. So like when you're a kid and you set up a lemonade stand and mom and dad pay for everything, it seems great. Hey, look, I just sold $10 with the lemonade. And they go, you can keep it, honey.
Right.
I think a lot of these CEOs of these startups remembered those days and forgot that mommy and daddy actually were like a bank and need to be paid back. And so, yeah, you built all this infrastructure. These micro factories aren't micro cheap. They're expensive. You sold maybe a few vans, and then what? Well, you got to service them. Those companies that bought the vans are going to call you up and say like, this isn't working. You have to fix it. So you need service. You need all that. And you bought all that equipment and all those supplies to make the things. And so revenue was not the whole answer. You need to be making money on each product, and you're not. I mean, it's just not going to happen the first couple of years. So their runway's about to run out. Not to mention, NASDAQ is going to call them up if they haven't already. And just like with Arcimoto, say, your stock price dropped below $1. You cannot be on our exchange for very long. So they're going to have to do a reverse split, which is not attractive to investors. And I think, look, I don't know. I think their days are numbered. March 9th, we're going to see their Q1 2023 report, and we'll get more financials. But I got to say, even their $250 million market cap right now seems very high to me for what they're doing. I think this is another case that we're going to see a lot of when money is getting expensive. When the markets are not doing well, these companies that were just like, yeah, money's everywhere. If we're not doing well, we'll get some more investors.
And I mean, this goes right along with what we've been saying over on our Patreon bonus stories a while back, where I had actually got, both of us had visited the company. And I mean, I'll just share this here. They had a bread bar. And you might be saying, I'm sorry, a what? Yeah, a bar with bread. So
fresh bread.
Every kind of bread, bagels, just loaves. Like I haven't seen like a loaf of bread like in a context where I could cut it and eat it in like 7 toasters of different kinds. So you could toast it in different ways, and 19 different kinds of cream cheese. Every surface in the building had little bowls of nuts, Brazil nuts, peanuts, cashews. I was like, wow. They had a room with a Chinese knockoff Spot robot in it, with a guy with a laptop
just playing with it,
who didn't know how to use it. That kind of thing was just like, to me, I was like, it could impress some people. Well, if they walked in, they could go like, wow, this place is swanky.
The reason we were in the UK was to go visit RoboRace, which was owned by a rival, and they spent a lot of money on something that didn't help them.
Right. I mean, they spent a lot of money on shipping us and Rich Rebuilds over to the UK. They rented out Silverstone Racecourse to have me drive 60 miles an hour on a race course where you're normally going well over 160. It was like me going slow on the highway around a course that is wider than a highway.
Yeah, it was a kind of a show in terms of like marketing where, yeah, the idea was okay, but they didn't implement it properly. I
also beat the robot, by the way.
And you beat Rich. But this is kind of par for the course here. They didn't implement it properly. Same thing here. It's not that their buses don't look cool, their vans don't look cool. That they do. It's that you have to implement everything perfectly, and you have to thread that needle perfectly to make money. And these companies they know how to spend it. And spending money is not the same as making money. So that's our disruptive investing. It shows that disruption, it has to be real disruption. It has to be economically viable disruption. And it shows that even if you want it to work, that's not enough sometimes. Yeah. And so a lot of us were fooled where we're like, oh, well, this looks really disruptive. But you gotta do it perfectly.
And that's the interesting part about market corrections. They allow you to see where mistakes have been made, because back when money was cheap, right? Back when everyone wanted to invest in anything that was an EV, this company looked very good. And a lot of people said, oh, I think that this could be the next thing, right? Because stock prices were high, everything seemed really rosy. Then when the rubber starts to meet the road, you start to go like, oh, they don't really have anything. And it starts to fall apart like this.
Yeah. It's a really good lesson, and it's actually why these corrections to the market are a good thing. They're kind of pruning the dead branches, so to speak. Hope you found this interesting. We'll see you next week on Disruptive Investing.
Oh, and if you didn't check out last week's episode where we talked about ChatGPT, you should just check that one out. Do yourself a favor. Go check that one out. Use ChatGPT. I think that it is one of the most transformational technologies if we're talking about disruption. Yeah. So definitely go check that out. We'll see you next week on Disruptive Investing News.